Our next session, Mark Pietrino from Benzinga, head market technician as well as head of education, with Let's Talk Technical Analysis. Mark, it is all you.
Okay, thank you, Todd. Thank you. That's a quite an energetic and enthusiastic introduction, and I appreciate it. But I guess we're in a good mood today because the market's coming back, making a move higher. So we're going to just talk a little bit about technical analysis. There's a lot of myths and misunderstandings behind it, but there's a lot of validity to some of it too. So we're going to just look through some of the traditional things. And remember, this is not any investment advice. This is just to teach. Hopefully, you will learn something valuable, and I can almost guarantee that you will. Just a little bit about my background. So I've been around the block a while, or quite a few times. Unfortunately, you get experience only comes with age, but I guess that's just part of it. So my first trading job was for Mario Gabelli, who is a very well-known money manager. He's on television all the time. He hired me out of business school. I was getting my master's degree in finance at New York University, and that's when I met Mario. And there was an opening on the trading desk, and I went in there, and I was my first trading job. Part of my role was to be a market maker. Seems to be there's a lot of questions about market makers these days, so that's why I just wanted to put that in there. I also worked for Steve Cohen after I left Gabelli. Steve Cohen he's probably most famous for being the owner of the Mets. He is also supposedly the person that the show Billions is about, and I have never seen Billions, but whenever it comes up that I worked for Steve Cohen, they always say, "Oh, is Billions real?" So I don't know. I'm going to have to punt on that question. I've been a member of the Market Technicians Association for about 21 years now. I have the CMT, and here's the thing: a lot of this technical stuff is, it's way more complicated than people think it should be. When we look at a chart, we're looking at supply and demand dynamics that are occurring in a market. We're not looking for anything magical or mystical or anything like that. So just a little brief background. Charles Dow, he's considered the father of modern technical analysis. He is the person who came up with the Dow Jones Index, which we now follow 100 and some odd years later. I think we also know too that the rice traders in the 1500s in Japan used charts, and that's where some of the original candlestick patterns come from that are still being used today. My guess is that the Romans and the Phoenicians probably had charting too. Their merchants were graphing prices of things. We just don't have any proof of that. But Charles Dow is a name you often hear associated with technical analysis because he is, a pivotal person on Wall Street. He founded the Wall Street Journal. He invented the Dow Jones averages, and these are still 125 years or so later, still watched very closely. Well, I mean, obviously the Wall Street Journal is read and highly respected, and the Dow Jones is widely followed. Then Charles Dow is credited with something called the Dow theory, which you might have heard of, and it's a way for analyzing market behavior, but we are going to look at some examples. So here are some of the basic concepts behind technical analysis. Markets are efficient, and all news is immediately discounted in the price. In other words, that's a fancy way of saying we use the price action to kind of get an idea of where the future action will be. For example, if a stock gets sold off really, really hard, like some bad news comes out on it, and it goes from, say, $20 to, say, $15, one of the things we can do is we can look in the past on the chart and see where there were levels that had previously been important. So say, for example, after this move down from 20 to 15, We see that over the last, or say 6 months ago, for instance, there were a lot of buyers at the $15 level of this particular stock. When it got there, for some reason, that was the price that the buyers came into the market. So if we see a stock that's going to 20 to 15 and we look back in the past and we see that there was a lot of interest at 15, there is a good chance that there will be interest there again. You might have heard the expression markets have memories, and that's what people mean when they refer to this, that there are certain price levels that are important and there are certain price levels that are not important. Sometimes we know why the level is important, sometimes we don't know. For example, say a stock gets to $100, or Tesla, for instance, has been trading right around $1,000. We know why $1,000 is important, because it is a psychological level. People like to buy things at nice round levels. A typical person, even a pro, a professional, isn't going to say, let's buy Tesla if it gets to $9.98 and 36 cents. They're going to say, let's buy it at 1,000, or let's sell it at 1,000. So in a situation like that, we know why a level is important. But in other situations, we don't know why. But as you'll see, we don't need to know why. We just need to recognize them. So when we look at any chart, we want to look at it through the context of what supply and demand dynamics does it illustrate. We are looking for things that are slightly out of equilibrium or way out of equilibrium. If something is in equilibrium, in other words, if the forces of demand or the buyers are equal or equated to the forces of supply or the sellers, the stock is, or the market is, in equilibrium. It's not really probably going to move unless some new news comes out. Well, we don't care about stocks like that. They bore us. We want stocks that are out of equilibrium, because when something is out of equilibrium, it tends to move. Most trading strategies are based on reversions. Stocks trade in a typical range. Every stock has its own personality, and it trades in its normal or average or typical range. If the price gets to an extreme above that, that's called overbought. You may have heard that term before. If the price reaches an extreme below the typical trading range, that's what we call oversold. Why do we care about this? Because there tends to be reversions. Things that are oversold or have been really beaten down by the sellers tend to bounce back or rallies. Not always, it's not a guarantee. Things that are overbought tend to sell off. So now technical analysis has a bad reputation, and frankly, I think it deserves it. I've been doing this for a long time. I got my CMT designation, I don't know, 22, 23 years ago. You might have saw that on my title. That's the Charter Market Technician. So I got my first interest in charting when I was working for Stevie Cohen at SAC. At Gabelli, there wasn't really too many chartists, but at SAC at the time, it's like all anyone did was look at charts. But anyway, there are a lot of people out there that, even some of the well-known names in the industry that you see on CNBC or whatever financial media, they don't really seem to know what they're doing. They don't understand the fundamentals. The fundamentals are what I talked about, supply and demand. There's no mystical, price targets we can draw from looking at a chart. I mean, we can get a good sense of where there's going to be an important thing, or an important level or trend, but it's not magical. Some analysts look for patterns on the charts, but they don't understand what these patterns illustrate. If you don't understand what the patterns illustrate, you're never going to be able to trade it. And what I teach in the class is that you shouldn't spend too much time worrying about what is or what isn't a pattern. I have seen a lot of analysts debate, oh, this is a head and shoulders, or this is a flat, or this isn't, or this is. It doesn't matter. We want to see what the fundamentals are showing us. You can argue whether something is a triple top or whether it's a head and shoulders pattern. Who cares? You're not going to get paid by remembering the names of the patterns. But what will help you is seeing the supply and demand dynamics that are shown in these patterns. So there's a lot of methods out there too that aren't even based on reality, which I'm not going to go into. But we always want to look at every chart as an illustration of supply and demand dynamics. Now I have a good, an analogy I like to use. Pretend this is, I don't know, the Dark Ages, and we're in Europe, and it's the year 800, and there's a market where farmers from all around come to bring their goods, and everyone comes there to buy and sell their goods. Now just say there's one road in and out of town, and one of the merchants sends out a spy to watch the road and sees that, well, let's say there's 2 cartloads of apples coming into the market. Well, typically say there's 20 cartloads of apples. Now that merchant will think, well, gee, there's a chance here there is going to be a shortage of apples. The demand for them will drive the price higher. So that merchant gets his word back from his spy and goes back into the market and goes around and buys up all the apples quietly without alerting the market or scaring anyone. And then when all the buyers come in and the market starts opening, people think like, oh, there's not enough apples, we need to pay higher prices. So this merchant might not have any particular expertise on apple growing. They may not be a farmer, but what they did was they saw, oh, gee, here is something that is out of supply and demand. It's out of equilibrium. That tells me the price is going to move. And it sounds like a kind of a silly example, but that is what we're doing here. Instead of looking at, farmers bringing in cartloads of apples, we're looking at charts. But we are doing, in essence, the very same thing. We're looking for things that are out of equilibrium, because when that happens, things move. Now, let me go back to what is could potentially even be the most important thing in all of trading. And it doesn't matter if you're a day trader or a long-term trader, it applies to any time frame or pretty much any style. Certain price levels are more important than others, okay? As a matter of fact, in the Benzinga's trading school, we have 8 specific classes. And one of the classes, the second class, the first class, number 1, is about just philosophy and the way we look at things. The second class is levels. That's how important I think they are. So like we said before, sometimes the reason why a level is important is obvious. Sometimes it isn't. Support, you've probably heard this term. Support is a large gathering or concentration of buyers who are looking to pay at or close to the same price. Say there's a lot of people that want to buy a stock at $15. Well, there's going to be a lot of bids in the market or buy orders for $15. That could create support. And the reason why it's called support is because if the price is going down and it gets to that level, there's going to be enough buyers to support the stock or support the price. The price will stop going down at once it gets to that level. So resistance is the opposite. It's a large concentration of sellers at a certain price level. So we have to remember some levels are more important than others. And what we want to do is we want to find support levels and resistance levels, because stocks stop going down when they get to support and stocks stop going up when they get to resistance. Of course, it's nothing, it's not a guaranteed hard and fast rule, but it's an important principle of markets that if you want to be a successful trader, you have to understand. And don't let the simplicity of this, the seeming simplicity of this, make you think it's not worth paying attention to, because you look at all these like webinars and things on YouTube, and there's all these so-called trading gurus, and they all have these really complicated methods that use, Fibonacci's and exponential moving averages and this, that, and the other thing. So people get this idea that successful trading is really complicated and it's really hard. Well, it is really hard to be successful, but it's not really that complicated. You don't need to overthink it. We don't need to have all these secret systems. And I can tell you, as someone who has literally traded directly for some of the best, Steve Cohen is, you know, probably the best trader of this age and potentially the best trader, that at least that I know of in the history of Wall Street. And I can tell you with 100% surety that he does not have some secret system that he developed or was revealed to him while he was on a vision quest or something like that. But I can also almost guarantee you that he would say, well, yeah, I pay attention to what levels are important. Where are things trading? So a particular level could be important for months, sometimes even years, believe it or not. There's examples of something that reaches a level that it hasn't been at in 10 years. And right when it gets to that level, it rolls over and goes lower. Now, I would think that most of the people who are listening now are interested in day trading. And as a matter of fact, I would probably be willing to say that most of the students in the trading school are day traders or have short-term horizons. And that's okay, because all the stuff we talk about here is applicable to any time frame that you're using. Like if you're a day trader, you might see a stock that a level that was support for, say, 9:30 in the morning till noon. Then the stock rallies up $1 and then it starts to come down. And you say, oh, well, this morning, this level was support. Maybe if it gets there, it rallies again. So maybe 1 or 2 o'clock in the afternoon, if it gets there, you place your buy order and hopefully it rallies and you have a profit by the close. If you're a longer term trader, say you're what we call a swing trader, their strategies usually last anywhere from day trading to maybe a few weeks or a few months. There's really no precise definition. They're not really looking at hourly support levels or intraday support levels. They're looking more at levels that are more important over the week or a longer time frame. And I'm going to show you some examples, and then we're going to have some time to look into the actual markets so I can show you some of this stuff in real time. I think one of the things that really stands out about the trading school, and that one of the things that we get a lot of really good feedback on, is that we are looking at the markets in real time. The way the classes work is we have the class and we talk about a particular principle. For example, today I am focusing on levels, right? And just coincidentally, right now we're talking about levels, but just coincidentally, this morning the class was about levels. So we talk about levels, we talk about what's a support level, we talk about what's a resistance level, we talk about possible reasons for why they form, how to trade them, most importantly, because people aren't coming to this class just to learn about the markets. Well, I mean, I guess some people are, but we want to apply all this knowledge to the market so we can make money, right? That's why we're here. So we review the fundamentals. Each class is a fundamental. Like, for example, tomorrow we're going to talk about trends. The day after, we're going to talk about momentum. We go through our 8 classes, and then when we get to the end, we start again. It's not just that it's over. We go back to the beginning and we review the principles, and so for instance, in 2 weeks from today, we're going to be talking about levels again in the class, but guess what? The markets are most likely going to be at different levels, so there will be different things in play. All right, so let's talk about support and resistance levels. We did talk about this, but I think going over it, kind of really pounding it into your head is really what makes you understand it. All right, so let's think about support, a concentration of buyers. Now, let's say a stock is at $30 and people want to sell it. They come into the market and maybe someone could sell their stock at $30, but after that, there's no one else willing to pay $30. What do the sellers need to do? Well, at that point, a seller would need to offer out the shares at, say, a discount. something to entice a buyer to come into the market. The buyer might say, well, you know, it's trading at 29 and a half. I'll pay you 29. Then the stock trades at 29, and then the same thing happens. More sellers come in. There's not enough buyers to absorb all of the shares. So some of the sellers have to push the price down a little bit. They have to basically offer the stock out at a discount. So this is what drives markets lower. When there is not enough demand or buyers to absorb all of the supply, it causes things to trend lower. When something gets to a support level, there's a change. At a support level, there's more demand than there is supply. There's enough buyers who are willing to buy the shares that the sellers can sell all they need to at that price. The sellers don't need to offer stock at a discount anymore. There's adequate demand to absorb the supply of shares. This is why things stop going down when they get to support levels. Market sell-offs pause or halt when they reach support levels. Now, let's think about a market going higher. This is the definition of what a stock market rally is. Excuse me. Buyers can't buy all the stock that they want at the current level. So they need to bid a higher price. They need to offer a premium. Just like the sellers needed to accept a discount, buyers now are going to have to pay higher prices. Someone might come into the market when the stock is at 20 and they might want to buy it, and the sellers might only have a couple thousand for sale and say, well, we'll sell you these at 20, but someone else might come along and say, okay, well, I'll sell it to you at 21. I got the lowest game in town, so you got to come to me. So what happens? Some of the buyers pay 21. Then the same thing happens again at, say, 22. The buyers want to buy stock. There's just not enough around, so they're forced to offer to pay a premium to draw sellers into the market. Now, when a stock reaches a resistance level, there's enough supply or enough sellers or shares for sale to satisfy all of the buy orders. The buyers don't need to pay premiums anymore. They can buy anything they, as much as they want to, as many shares as they want to at that level. So that is why stocks stop going up when they reach resistance levels. So it's pretty, it's common sense, it's intuitive and logical. It applies to any market as well. Think if you can understand the real estate market between what is a buyer's market and a seller's market, you can understand technical analysis because it's based on the same principles. Think about what is a buyer's market. A buyer's market, there's a lot of sellers around. The sellers need to go to the buyers and pay whatever the buyers are willing to bid. Now, what about a seller's market? That's the opposite. And we saw that around here where I live when people started moving out of New York a few years ago. There was a lot of buyers coming into the neighborhood, so sellers could wait for the buyers to come to them. So it's supply and demand. If it's supply and demand, if there's a lot of demand, the buyers have to go to the sellers. If there's inadequate demand, the sellers have to go to the buyers. And that is what we're looking at here. We just see it in the form of a chart. So how are levels used to profit? Well, we're going to go over these. Order placement, where you're going to place your orders. For example, say you like stock XYZ, and you say, oh, if XYZ gets to 20, I'm going to buy it. Well, now say you look on the chart and you see that there's a lot of support. There's a support level at 21. You look back on the chart, you see that there's support there. There's a lot of buyers at that level. Now let's say the stock is at 25 and it starts to trend lower. So the person that wants to pay 20 says, all right, cool, it's coming my way. I think I'm going to buy it. But guess what? The stock gets down to the support level and there's a lot of buyers and it turns around and it goes back higher. So this person would have missed out on buying something because they weren't aware that there was a particular level that they should pay attention to. Same thing with selling. you might say, all right, I got stock XYZ at 50, it's going my way. If it gets to 80, I'm going to sell it. Well, you could look at the chart and see, man, there's a huge amount of resistance around the 79 level. Well, in that case, what would you do? Well, maybe you want to place your order at 78 because the stock might get up to 79, hit that resistance, roll over and go down. Now, if you were waiting to get your price, you wouldn't have gotten it because you weren't aware of where that resistance was. So you're selling it at a little bit lower of a price, but that's better than having the stock reverse and go lower and go all the way back and end up with a losing position. We can use this for our price targets. You buy a stock, you think to yourself, all right, where am I going to sell it? Well, you can look on the chart and see where is there possibly going to be resistance. Same thing with buying. Something's in a downtrend, you think like, gee, well, where do I step in and buy it? So let's look at some pretty clear levels here. And we're going to look at this live when I'm done with this presentation, but this is the spider, the SPY, SPY. This is an ETF. It follows the S&P 500. So this is extremely widely traded. This is a broad, it's a broad measure of the markets. There's 500 stocks in it. It's got all the big ones you would think of are the big names, Apple, Microsoft, so forth. But this I want to show here has an example of how certain levels are more important than others. And this is a little bit of a longer term chart than something a day trader would typically look at. Each one of these rectangles is 1 day. And this shows from May through October. Now let's take a look here. So we're in June and SPY gets to the $425 level. What happens? It hits resistance. Then it goes lower. Then it starts to rally. It goes through that level again, and it hits resistance again. Then it comes back down. And where did it find support? At this 425 level. 425 is an important level. It was a peak here. When stocks go lower, they tend to find support at recent peaks. Same thing with this here. In early September, or I'm sorry, this is late August, SPY sell off. Where does it find support? Right around the level that was a peak. So this level is important as well. Why didn't it turn somewhere in here? I don't know. Why didn't it turn somewhere in here? I don't know. I don't know why these levels became important. I know that it became support because it was resistance. So this is a common phenomenon when we see these important levels. What was a resistance level can become a support level. And we see that here in two clear examples. The traditional reason given for this seemingly mysterious phenomena is seller's remorse. We have people that sold their stock here, sold their SPY here around 425. Then it went all the way down to 415, and the people that sold were thinking like, wow, I made a great call. I made money on this thing. They're feeling pretty good about themselves. Then what happens is it rebounds and it rallies back up through their selling price. Now a lot of the people that sold here say to themselves, maybe I wasn't so smart after all. Maybe I made a mistake. A lot of these remorseful sellers decide to buy their stock back, but they're only going to do so if it gets to the same level that they sold it at. That way they can kind of mentally erase the mistake in their head. As a result, what happens? We have a whole bunch of remorseful sellers placing a buy order or buy orders at the same level that was a resistance level. This is why this level became support. If there's enough of these disgruntled or remorseful sellers placing buy orders, what was resistance can convert into support. And we see the same thing up here around the 437 level. What was resistance becomes the support. So I just want you to see that in pretty much any chart you look at, you can see examples of certain price levels that are more important than others. Now, if you're just starting out and you're new to the game, I don't expect you to be able to do that. Like anything that's worthwhile doing, it takes some time and it takes some experience and it takes some practice. But just knowing to be on the lookout for them now is going to give you an edge, or it's going to help you. Like if you never get any education about the market again, just knowing that certain price levels are more important is enough to give you an edge on a lot of the other people that are trading. Some people come into it and they don't even know that. They don't even think about that. I mean, I've been doing this for so long, it almost comes second nature to me now. But I think if you spend a little bit of time and some practice, it could become second nature to you too. So now this is, again, 6 months. Now let's look at a shorter time frame. This might be something that would be more on the radar screen of a day trader. I get a lot of questions about what time frames someone should look at, like a day trader. And my answer is, well, you should start out with a longer term time frame. It's kind of like those Russian dolls where you open one and there's another one inside it and another one inside it. You want to start at the bigger picture, because if you're a day trader and you're day trading on this day, whatever it was, August 20th, well, you would want to know that this level was an important resistance level, because that trend might become in play during the day, or that level might become in play during the day. So I would say start off with a little bit of a longer picture, so you know if there's important levels. Like look down here, like if SPY ever gets back down to around here, 405, you're going to want to know that that's a former bottom. So now we look at the shorter term chart. This is 5 days, and what do we see? Well, we have a similar phenomenon here. We see that for some reason over this 5-day period, the 469 level was important. And we see that we had support here. This is the 18th and the 19th of, I assume November. Yeah, so this is probably November. So we have support here on the 18th and the 19th. And then we get a little bit of a rally. And what happens over here on the 24th and 25th? We have the opposite phenomenon. Here we had resistance turn into support. Now we have support turning into resistance. Again, it shows you that some levels are really important. For some reason, 469 was an important level. Now, this happens because of the opposite phenomenon of seller's remorse. This happens because of buyer's remorse. People bought the stock here. When it spiked up, they thought, man, I did a good job here. I made some nice money. I'm happy. I made a good trade. But what happens here? Well, the stock falls right back through their level. Now we have people that bought the stock here or bought SPY here that say, darn, I made a mistake. I shouldn't have bought it. I want to sell it, but I don't want to take a loss. So here's what I'm going to do. If it gets back up to my level, I'm going to sell it at the same price I bought it at and break even. So we have people that buy the stock here are placing their sell orders over here. You see that's the first one, but in here. And if there's enough of these remorseful buyers placing sell orders at the level they bought at, it could turn the level from support into resistance. So just another example of levels, certain levels that are more important than others. For some reason, this 469 level, well, the market's rallied and now it's trading off this chart here, but on a longer term chart is just maybe not as important as it is on the shorter term time view. Here's a 1-day chart, and we can see the same thing. So now if you're a day trader, here's your 1-day chart. The stock gets up to resistance, and what happens later on in the afternoon? That same level becomes support. So if you're a day trader and it's 310 and you see, SPY is trading around 469.50, and now it's selling off down to 469, and you look back and you say, oh, around 1 and 2 o'clock, that was a resistance level. Maybe there will be support there now. So you buy it, and sure enough, there was support, and it bounced into the close, and you would have made 50 cents, which doesn't sound like a lot, but if you're an options trader, that could have been a significant return. But it's the same principles apply. It's a fractal nature of trading. As long as we make sure we're looking at the same time frame and everything, then we should be okay. For example, this chart here is looking at days. This is a longer term time frame. This is 6 months. This chart here is looking at, I believe, 5-minute intervals. So now each one of these rectangles is 5 minutes, not a day. When we get to an even shorter time frame, the 1 day, each one of these rectangles is 1 minute. But we see the same dynamics are at play regardless of the time frame. This is the concept of like the fractal nature of trading. All right, so just let me show you a couple more things. This is the Russell 2000 ETF, IWM, longer term chart here, 11 months from the beginning of the year up until about a week ago. Look here, really clear support around the 211 level. I mean, if you're a trader and say it's like right here in May and you see, man, this thing is in a big move down. Wow, look at those clear levels. So you buy down around here. We can also see, I don't have it outlined here, but up around the 231 level or 230, I would say maybe 233, we have a clear resistance level. But anyway, so say the stock rallies, gets to resistance, the trader sells it. Another few weeks later, it starts coming back, and it's like, oh, man, the last 3 times it got to 211, it bounced. And then maybe it'll bounce again. Then they buy it. Gets back down here again in August. And you say to yourself, gee, the last 4 times it got to 11, it bounced. Maybe it will find support and bounce again. So markets have memories. A level can be important for a long time. And then here's an example of an IWM, the same thing, just on a 1-day time frame, something a day trader would look at. These are 1-minute intervals. So between, say, 10:45 and 3 o'clock, we had a pretty clear range. A day trader would have sold at the top and bought at the bottom. Then for some reason after 3, we get a little bit of a breakout, and guess what? What was resistance now converts into support. So I'm going to just wrap it up with that, and we're going to look at some of the actual markets and see what important levels are at play now. So just to wrap it up here, my background is pretty extensive. I have a lot of experience. In addition to trading for Mario and Steve, I was also the head of trading at 3 different institutional money management firms. And then about 5 years ago, I just decided to leave the industry because it just got to the point where it wasn't fun anymore. When I first started like 25 years ago, it was a fun place to be. There was a lot of camaraderie and a lot of going out and going to games and going to dinners, and that all kind of changed. It got very compliance oriented, very computer driven. So I decided that I wanted to go into online publishing and writing about the markets, and that led to teaching, and that brings me in a somewhat roundabout way to where I am now at Benzinga. But I'm very happy to be doing what I'm doing now. So again, we base our class on fundamentals, logic, common sense. We don't use esoteric or overly complex theories. It's very applicable to day trading. Students too, I teach them to use or develop strategies that fits their personality. What works for one person might not work for another person. If you made Tom Brady a linebacker, he probably wouldn't be that good, right? So some people are high energy and they like looking at the markets and they like reading all the news. Well, they might have the type of personality that would be a good day trader. Some people are more, chilled out, or maybe they have a job and they're on the road and they can't really look at the markets every day. They might have a longer term strategy. What works for one person is not going to work for another. So what I try to teach in the class is here's all the tools. These are all the different indicators. It's like you're a carpenter, it's like, well, this indicator is your hammer, and this one is your screwdriver, and this is your wrench. But you have to figure out the best way to put things together that works for you. And so far, I'm very happy with the results. So we look at the real-time market, which is what we're going to do now. Remember, the media is generally wrong when they explain the markets, and we talk about why, what the real reasons are. These are, if you want to, or if you're interested in finding out more about the trading school, you can contact Rodrigo, just Rodrigo at Benzinga. Here's his number. We have the link here for the class if you're interested. And let's see. So now with that, let's look at the market. So now let's go back to our SPY. All right. Now, we just had a big sell-off. Well, I mean, I wouldn't say big, but decent, I guess. So in the class, we talked about this extensively over these days here, the last part of November, okay? We saw that this uptrend was broken. Meaning the sellers were taken over and the market went into, a sell-off. So we say to ourselves, well, where is there a chance that this sell-off is going to end? We looked back in time and we see that in late August and early September, the 453 level was resistance. Levels that were resistance can become support. Remember, it's that seller's remorse. People sold, and when it goes higher, they want to buy back, and they place their buy orders around here. So, we got to within 2 or 3 points of 453, which for a stock that's $450 is really close. Friday's close was literally at 43. Friday's close. Yesterday we held, and now we're having to move higher. So now what would we be looking at? Well, where is there possible resistance? Remember, markets have memories. A level that was resistance before could become resistance again. So if SPY gets up to the 470 level, there's a good chance that maybe it moves higher, but there's a good chance that it stalls out there for a little while. I don't think it would just trade right through it. But of course, there's a chance that it crashes into it and rolls over like it did here. I think something to just show the importance of levels, and I think hopefully we still have some time, and I'll just see if what Todd is thinking. But look at this now. This is the oil chart. All right, crude oil. Oil's been in the news a lot because of inflation. And let's keep in mind, this is a multi-trillion-dollar market, worldwide players. Back in May, when we had this sell-off, we found support around 62.50. Selling off in August, we look back. Where might this sell-off end? Well, gee, the sell-off ended at 62.50 in May. Maybe it'll end there again. Same thing happened. Fast forward to December 2nd, and we had this big sell-off. This was that day after Thanksgiving. Where was the low trade? $62.46. So within 4 cents of this round level. And look what has happened. Oil is now more than $10 higher. So this is a perfect illustration of how there are some price levels that are more important than others. And if you know where these price levels are, you could profit from them. For instance, there were people buying oil futures here because they saw that there was support here. There were people buying oil here because they saw that there was support here and here. Oil keeps rallying. Where will the sellers come out? Well, up here around 84, the former peak. So pretty much we could look at any chart and we could see examples of important levels. Let's see, what else can we look at? We were looking at the Qs too, the triple Qs.
Yeah, let's go through the Nasdaq, and then I know we're going to want to take a break. But I
Okay.
love the, you've gone through all of the examples of the different trends and levels and support and resistance. Actually applying it a little bit is always kind of helpful. So yeah, please give us the Nasdaq one too.
Yeah, so this is the triple Qs, which a lot of people trade. It's the Nasdaq 100. It's very technology oriented. But again, we see the same principle that I was discussing at length, the importance of certain levels. Back here in the beginning of September, where do the Qs run into resistance? Around 382. We had this sell-off. Where do they find support? Right around 382. They didn't find support there just randomly, okay? They found support there because it was an important level in the past. And now we can see we've held the support and made a big move higher. Same thing going back here. This sell-off didn't end here randomly. It ended here because it was a support level in the past. So in the institutional trading world, this is what we're doing. We're looking for what levels are important and how can we trade around those levels to profit.
Well, thank you, Mark, for that. That was fantastic. One, learning the concepts, the history of technical analysis, why it's important, how you identify some of these different levels, support and resistance trends. And then a little bit of practical application to it is always helpful so people can actually see it in action from recent markets. So thank you very much for that. I do want to remind everyone too, is when you're looking at these levels, how could you take advantage of these opportunities? Clearly, Nadex binary options is one way for you to do that. And then the second half of the day, we're going to be talking about knockouts and call spreads. And if you're not familiar with those, we'll be covering those products as well. But leveraging your technical analysis skills and tools comes in handy when accessing Nadex markets.